very warm welcome for today's webinar. On behalf of NISM and IndiaBonds, I would like to take this opportunity to welcome you all for today's webinar, which you are all aware the topic will be factors to consider before investing in bonds. Myself, Amir Sayed, working with NISM. Along with me, today we have a renowned speaker from the industry who will be taking a webinar today. We have Mr. Vishal Goenka, co-founder of IndiaBonds, and Dr. Kapil Shrimal, associate professor at National Institute of Security Markets, NISM. Before we begin, let me allow a quick introduction about our speakers. Dr. Kapil Shrimal is an associate professor at NISM, and he is having more than 13 years of experience in academics and 1 year in experience of corporate as well. He has started his career with ICICI Prudential LIC and worked with institutes like Prestige Institute of Management and Research, Indore, Symbiosis University of Applied Science, Indore, Marwadi University, Rajkot. His last assignment was with PIMR, Indore. His main area of teaching and research is financial planning, portfolio management, derivatives, financial modeling, financial management, etc. He has conducted many investment awareness programs on behalf of SEBI, NSE, and ICI. Let me give a quick introduction about our other speaker, Mr. Vishal Goenka. Mr. Goenka is a seasoned expert with over 20 years of experience in the fixed income, currency, and credit markets. He has held key leadership roles at global investment banks such as Deutsche Bank, Merrill Lynch, and RBS, operating across major financial hubs, including London and Singapore. Mr. Vishal's extensive background covers sales, trading, and credit trading, with notable experience at Deutsche Bank in Singapore and Merrill Lynch in London. He holds an MBA from prestigious London Business Schools. Before we start, let me convey the major areas which this webinar will touch upon. Today, we are going to cover investing bonds can provide steady returns and lower risk compared to stocks. But there are several factors you should consider before making an investment. So today, we are going to learn the major aspects of this only. Before we start, just few housekeeping announcements. Like we'll be taking all the questions at the end of the webinar, requesting all the participants to put their queries in the Q&A board. Our speakers will be happy to answer you all the questions. So without taking into further time, I would like to hand over the webinar to our speakers. Over to you, sir.
Thank you, Amir, and a very good afternoon. This is Vishal from IndiaBonds. We're very happy that off late our webinars, thanks to our partnership with NISM, we're seeing at least 3,000 to 4,000 people registering, and very excited that this asset class is of interest to everyone. Again, a very warm welcome. We've received 150 questions already before the webinar. A lot of those questions actually will be answered as Professor Shrimal and I take forward this webinar. We will do our piece in about 30 minutes, and then we would really like to address the questions. So I hope you enjoy, take notes. If you miss out on something, you can always write back to us. Over to Professor Shrimal.
So thank you, Amir and Vishalji. So as we know that Amir has already discussed with you what are the topics that we are going to cover. So quickly, in the today's session, me and Vishalji will cover that what are the various types of the bonds or what is NCD that we'll discuss. How the retail participations will take place into this bond market, especially what is the size of the market, how they can invest into the market. That is a key objective of this particular webinar today. What are the 5 factors before investing into the bond market, investing into the bond, and make your bond investment work with you. So how you can invest in this particular bond market, and what is the risk, especially because when we say about the security, yes, security is subject to market risk. So what are the risks involved into this particular fixed income security that we are going to discuss. And at last, we'll cover the question and answers in this particular webinar. So starting with the first introduction of the bond market, with what bonds or the fixed income securities are. As we know, bond is a financial instrument. Okay, that has been raised by the company to raise a fund, that is to borrow the capital from the market. So company is always known as a borrower, and the investors are known as the lender to the company. So company has the 2 options. Let's take an example. The 3 options rather we can say. They can raise the capital in the form of equity. They can directly come with an IPO. They can go to the bank and take a loan from a bank. And number 3, they can issue the bonds or the debentures into the market, and the retail investors or the institutional investors can invest into this particular bond. Now, once you invest in that particular bond, you will be the lender to the company. So the company will have obligation to pay you the fixed interest. That interest is known as a coupon. Every year, every month, every quarter, or every semi-annually. So that depending upon the nature of a bond that we can say. So in general, there are the two parties involved, the company that is the issuer or the borrower. Now, generally, the bond is issued as a face value of 1 lakh rupees. But yes, there are the GSECs or especially when we say about the GSEC market, the retail investors can invest from the 10,000 rupees also. So you can invest minimum of 10,000 rupees as an investment into the bond. But whenever the issues are there, so that will be as a face value will be there. So this face value of a bond can be the issue price also. It can be issued at discount also. So that part is even in the first webinar we discussed. Whatever the face value will be there, on that face value, company is going to give you the fixed interest, or that interest is known as a coupon basically. Every year, semi-annually, quarterly, monthly, that depending upon the nature has been predetermined. So let's take an example. If the face value is 1 lakh rupees and 10% is the interest, and the yearly is a frequency, the investor will receive or the lender will receive the 10% of 1 lakh rupees, that is 10,000 rupees every year as a coupon. That is the first part. Now at the time of maturity, so if the bond is having a mature bond, it is not 81 or perpetual bonds are there. If the bond is having a maturity of let's say 10 years, so at the end of the maturity, at the end of the 10th year, the investor will receive its face value back. So principal amount back will be there. So guarantee of receiving the principal as well as the receiving the coupon every year. Plus, compulsorily this bond has to get a rating from the credit rating agency. Any minimum one credit rating agency is required. So there are the investment grade bond, non-investment grade bonds. Vishalji will cover this slide in later on, but yes, it should be credit rating. And yes, whatever the investors are doing the investment, it complies with all the regulations of the bond market. So this is the basic of a bond nature. So when you take, the company is taking a loan from you, you are giving a loan to the company will pay interest to you, and at the time of the maturity, the principal amount will become back to the investor. So this is a very simple process of the fixed income. It is not like equity. In equity, that might be possible. Even we discussed in the last webinar also, the principal amount guarantee is not there. But here the principal amount guarantee is there. That is the basics of the bond. So if any doubt will be there, definitely we'll discuss at the last. So over to you, Vishalji, on the next slide.
Yes, so thank you, Professor. One little change that everyone should notice has happened, that bond face value now can be issued from as low as 10,000 rupees.
10,000.
So SEBI's new regulation, which came into effect, and people can start, this is a capital preservation instrument and can use to diversify their portfolio, even starting from 10,000. You know, these webinars we always find are interesting if there's an interaction. So we have some polls for you in the middle. I think this is time for the first poll of the session. The poll question, you have 30 seconds to answer. What is the biggest barrier to your participation in the bond market? Lack of knowledge, accessibility to the market transparency, lack of investment option, or the ticket size? Great. We have 288 respondents. Lack of knowledge, people say 55%. So you're in the right place. You're here at the webinar to learn. Accessibility to the bond market is 24%. We will cover this today, where I'll give you a demo as to how you can easily access the market, and also transparency will be an issue. Ticket size, only very small amount of people have said, which is very interesting. In bond IPOs, you can invest from as low as 1,000 rupees. Very interesting. Let's move on to the next slide. So this, you're very right. The lack of awareness is one important thing. The way to look at it is that if you think of risk and return, these are the big asset classes in the country. In FDs is a $1.5 trillion market, and all our parents and grandparents told us to invest in FD. Retail participation is 7%. Equity, which is now a 5 trillion market as of 31st March, retail participation is about 20%. In bonds, lack of access and availability and transparency, a lot of the issues that you said, retail participation is only about 3%. And the reason has been education, accessibility. There was not enough regulation before, and we will walk through the regulation that has come in the bond market. It is a SEBI regulated online bond platforms now. So you have the protection, and also you have a multiple of choice. All the reasons cited on the right have been addressed in some form or the other as the development in the bond market has happened. Back to you, Professor.
Okay. So then, like, your investment should be, when we'll say about why we are investing in the bond. So number one that we discussed, to provide a regular income. So I'm just giving a basic example to you. Let's take an example. You have a corpus with you and you're a retired person, or you're planning for the pocket money for your kid also. That is again one of the good example. And you want to give the regular income on that particular corpus. So you can put that money or park that money into the fixed income. That will give you the regular income in the form of the coupon that Number two, that I discussed in the first slide also, the capital protection is there. So whatever principal you're going to invest into this particular bond or fixed income, that particular principal will receive back to you at the time of maturity. The two part is the capital protection will be there. And as we know, all know that there is a saying, never put all the eggs in one basket. So yes, so if you are investing in only equity, so there can be the risk of proper diversification is required. Again, in the bond, there can be the various classes will be there. But yes, to put the asset class in the various diversification option to minimize your risk and maximize the return. So diversification part, bond should be, you should invest into the bond and fight inflation with you. So we all know inflation is a major part which eat our inflow or which eat our money appreciation, that we can say. So if you are putting a money into the scheme where it is not beating the inflation, or you're putting the money into the securities or the investment you're doing which is not beating the inflation, that is again a challenge for you. But some of the fixed income securities at least beat the inflation. So if you're going to the inflation linked bond or some bonds are there, so that will beat the inflation to you. So to fight against the inflation, protect your money, diversification, regular income is the best part to investment in the bond. So these are the things where you should invest in the bonds.
No,
Anything
definitely. Thank you. And I think just adding on to that, most of us have only one source of income, either our job or our profession,
Yes.
or we have, we look for much higher returns via equity. But bonds is one way you can add an additional income. A lot of people invest in bonds to match their EMI cash flow, for example. So there are various reasons that on the side you create another stream of regular income. And again, we'll head on to our next interactive poll question. Which factors influence your investment decision the most? Returns, risk, or credibility? We're getting very good participation. 10 seconds to go. Okay, excellent. 360 answers. Returns and risk are actually equal at 41%. So again, you're in the right place because bond investment is about a balance between risk and return. And 18% people out of the 360 people who have voted for credibility. So now we come to the core of our session today, which is what are the 5 key factors for bond investments that you should keep in mind. Again, a lot of questions have come, Q&A, and a lot of clarity you will get from here. The most important factor for people who do not understand bonds is credit rating. Now, what is credit rating? For people who understand CIBIL score, right? What is your CIBIL score? If you have a high CIBIL score, you will get loans at a low interest rate level. If you have a low CIBIL score, you will get interest loan at a higher level. A credit rating is exactly how risky is the issuer. So the green to red will give you a hint. A AAA issuer is supposed to be the safest after Government of India. The Government of India issued bonds are called risk-free because, you don't ever think the government is going to default in your own country. Even in international scenarios where there have been government defaults in very small countries in Africa or recently Sri Lanka, the domestic bond market never defaults. AAA companies are usually large public sector companies, AA plus, single A, AA minus. You go down to BBB minus, which becomes a really dangerous area, though it is still called investment grade. You should be very aware of the risks and the returns. In one of the slides, I will show you what are the expected returns across the credit rating. But this is the first sanity check, even if you're not an expert, as to what is the rating of the issuer. These ratings are given by SEBI registered rating agencies. We've named a few in the country: CRISIL, ICRA, India Ratings, CareH. One of the questions was, which are the better rating agencies? So we can't comment, but CRISIL and ICRA have been doing this for decades, for tens of years, and are also owned by large global credit rating agencies. So when you're thinking of a bond, first is to see what is the credit rating to measure your risk. Obviously, for higher risk, you should get higher return. For lower risk, you will get a lower return. The next factor to look at is the maturity of the bond. What does this mean? This means if you have loan to the company, will the bond mature in 2 years, which means you will get your principal back in 2 years. The company will pay you interest through those 2 years. It's like giving money to your friend. Okay. You give your money to your friend like Suresh. Suresh says, Are, give me 100 rupees or 1,000 rupees for a year. I will return it to you in 1 year's time. That is exactly what maturity is. The bond is something where all the terms of your contract are mentioned, and maturity is very important because that you have to match to your investment horizon. For some people, they want to buy a house or they want to send their kids to education. You want to buy a car or a motorbike in 2 to 3 years. You want to save money and not necessarily put everything in more volatile, risky assets. You say, okay, I will buy a 3-year maturity because in 3 years, I will use the principal to put a down payment to a house or a car or my child's education. The important thing to remember is something called the longer the maturity of the bond, it is more risky. Very simple logic term, not to confuse in jargon. If you were to give someone money and he says, I will return to you tomorrow, you think there's very little risk. Then he says, I'll return to you in 1 year. So you want to know where he lives, you are aware of him. If a person gives you money and says, I'll return to you in 5 years, you will consider it more risky, right? Because in 5 years, what can happen, you don't know. So that's the simple logic for a fixed income and bond also. The longer the maturity, it's considered to be more risky. Also for movement in interest rate. So one question comes up, how does interest rate and return on bond move? So remember simply, it's like a pen. When interest rates go up, yield on the bond or the return goes down. When interest rate go down, when interest rate go down, the price goes up. And when interest rates goes up, the price goes down. Yield on the bond is nothing called returns on the bond. Yield to maturity if you hold a bond to maturity. A lot of times people invest in bond depending on how often they need interest rate. If they need monthly or quarterly, so you can structure bonds to match your monthly or quarterly requirements. It's time for a third and final poll at this stage. Let's run that. What bond maturity period would you typically prefer? Less than a year, 1 to 5 years, long term, which is more than 5 years. Let's see if we can cross the response from last time. We have 10 seconds to go. Excellent. About 400 people voted. Again, 17% said short term, which is less than 1 year. 65% said 1 to 5 years. Honestly, that is the right period to choose from bond maturity. And long term, very good. 18% said they want to invest for more than 5 years. This is finally moving to what risks to keep in mind. We'll give you an idea of the returns you get. So central government is risk-free. You can earn from 675 to 7%. A AAA bond gives 7 to 8. These are sample names which we've highlighted from IndiaBonds website, which currently what is the yield range. AA will give you 8 to 10%. A single A, 10 to 11.5% in subordinated debt of small finance banks. Triple B onwards, you are taking much higher risk and you get paid for that, 11.5 to 12.5 to 13%. So to match what your risk profile is very important. I would like to highlight bonds are not guaranteed. Bond issuances are not insured. Like any financial security, there are risks to it. There are also possibilities of default risk. There's 2% default rate in the country, but there's $2.6 trillion bond market, right? So you choose your risk profile, and this is a rough guidance as to how to pick your return on each of these. Back to you, Professor Shiva.
So thank you, Vishalji. Now we know, like equity, there are again the bonds are there which are listed into the market and which are unlisted into the market. So whenever it's about the securities, if you invest into the listed security, it is always benefited to you because the regulatory guidelines will be there. So when it's about the listed bonds, the regulatory is the SEBI. And for the unlisted bond, the company must register under Companies Act 2013. So company must be the public limited company will be there, or the limited company will be there, which will be registered under the Companies Act 2013. The listing of the listed bonds will be done on the exchange like the NSE or BSE, but the unlisted bonds will not listed on any of the stock exchange. So no approval will be required for the stock exchange. Again, we'll say about it is listed on the exchange, so liquidity will be there. So for the liquidity, either it can be traded through exchange, or the request for quote platforms will be there on the platform of NSE, BSE, or platforms are there, or it can be traded over the counter also. But the unlisted bonds will be always traded over the counter. That is a part. So over the counter means it is not traded on the exchange. So no exchange is involved over there. Now, if the company doesn't pay the interest on time in the listed bonds, so there is a penalty of 1% per annum additional to the delay of the listing of a part. Number two, that is a 2% additional interest delay penalty will be there in the security creation, and 2% per annum on the coupon interest rate in the case of the default in that case. But if unlisted companies there, if they delay your coupon, if they delay your maturity, there is no penalty will be there. So if you are investing into the listed bond, you have a chance to receive the additional penalty or interest as an investor if company doesn't comply the obligations that the company has given to you. And yes, the disclosures are there. So if the company is listed, so disclosures of the financial, corporate governance reports, everything will be done on the platforms, but there is no comply by the regulatory body on the unlisted bonds are there. So if you're investing into the fixed income security, again, that is a suggestion that it should be listed because it will provide you the liquidity, it is regulated, proper trading can be done, and the guidelines will be followed by the regulator. So this is the difference between listed and unlisted bonds are there. Anything you want to add, Vishalji, over here? Or
No, so absolutely for all our bond investors, investing in listed is very, very important. Unlisted is like a contract between you and the company, and no one can enforce it. But if you have listed, which is bought from SEBI registered entities, then you have protection of SEBI. You can go to SEBI. The disclosure norms and governance norms, as Professor Shrimal said,
yes,
is much, much bigger. We highly, highly encourage only to invest in listed securities.
yes. Next, please. Now, yes, the risk is always there. So we started with the risk. So when you're expecting a return higher than the market or moderate return, the risk is there. So when you invest into the GSEC or any of the bond or the corporate bonds will be there. So first challenge with the liquidity can be one of the issue if that bond is not have the proper tradability opportunity on the platforms or the market will be there. So liquidity is the biggest issue. If the market is a crisis part is also there, the liquidity challenge will be there. So first risk is the liquidity. It means that whatever amount you invested, if you want to liquidate it on the next day or third day, if the buyers are not available, so liquidity issues will be there. But to overcome with this liquidity, SEBI and other regulators are also doing lots of jobs. Even if you'll see recently, SEBI has come with a consultation paper related to the liquidity of the fixed income securities or corporate bonds into the market. RBI is taking for the G6 for the liquidity, they're taking a part, but yes, liquidity is one of the risks. Number two risk is that the market risk that we can say that is much more bigger. So we all know market is nothing but the behavior of the investors. If something happened to the market means the interest rate or the global market or the geopolitical risk or the country risk. There can be the different types of risk will be there. Due to risk, investors always take a panic or the government has to take some decisions related to the major reforms into the economical like the repos or CRR or other interest rates will be there. If the rates are changed, it will be impact the yield of a bond. And if it will impact the yield of a bond, definitely it will impact the price of a bond. So that is the biggest challenge. And in the past, you can see related to the market risk, the Fed has changed some rates. And due to that, the major bank in the US falls due to this market risk is there. So yield has suddenly increased and the prices of the fixed income security went down. So that is a risk. Next risk is the credit risk. So if suddenly the credit rating went down, falls down of that particular, for example, the credit rating given agency has given the AAA rating to that particular fixed income security bond into the market, and suddenly due to the management issue or due to the funds issue or due to the any other issue, the rating went down to the A minus or A. In that case, again, the valuation of the bonds will go down into the market. So these are the issues which the risk of as an investor you always face a part. And yes, the fraud risk is there. So fraud risk, if you are investing into the unlisted bond or you're not buying that bond from the proper platforms or channels, so frauds can be happen to you. So these are some of the major risks. Apart of these, there can be different risks will be there, but these are some of the major risks which impact your returns or expected maturity at the time of you need a money back from you. So these are the parts. Vishalji, if you want to add on this side.
Yeah, no, so absolutely. No financial investment is without risk. So why to buy bonds? Because they can give you much higher returns than fixed deposits, keeping capital preservation, but not as volatile as equities, right? So as you've seen recently also, equity markets can go up or down. So this is a good way to invest in bonds. I think the next section, from the last two webinars, we learned that people want to understand how to access the bond market. And I think, Professor, some of your students are also joining us. So we'll give you a quick 5-minute demo, and then I will pass on to our esteemed partner NISM to talk about their programs. So this is on our website. You sign up very simply. KYC has become very simple these days. This is not a video. You just have to enter your PAN and Aadhaar numbers. We send it to DigiLocker, which is the central repository. I'm just showing you how simple it is. It is very OTP oriented. You confirm your details and your personal information. The entire process takes only 3 to 4 minutes. You can add any bank account in this country that you have. The system automatically verifies you, and you can add any DMAT. DMAT account opening is important for bonds, but not necessarily with us. We do a risk profile check as per SEBI guidelines. You e-sign this, OTP verify, and your KYC is done. So before you can buy anything, as per regulation, you have to be KYC compliant. Now, I will just show you a journey quickly as to what to look for on the bond side, on the platform, and how to navigate that. So this is the platform. It basically offers you bonds in various categories. You can simply choose new arrivals, high yielding. Some people like state guaranteed bonds. You can choose state guaranteed, minimum 10,000 rupee bonds, secured, GSEC, and that on. So I'll give you an example. Let's say you want to buy this Indostar bond. This now gives you all the details. The rating of the bond, the maturity, what is the yield? In this case here, you can see it's going to give you 10.3% yield. You can go down and read what will I earn, the entire cash flow of the bond. You can download rating reports to understand more about the company. We always advise all investors to read and study about the company. You click buy this bond. It gives you details, confirm and proceed. And that's it. I will not make any payment. I don't intend to buy this bond, but you go proceed to pay. It is integrated with Razorpay. The most important thing about buying a bond online through registered SEBI entities, it's even better than equities because your money does not come to the platform. Your money necessarily goes to the National Clearing Exchange, to the RBI account or HDFC account, National Clearing Exchange, who will credit the securities to you. Similarly, secondary market is where you can buy, and there are bond IPOs. So right now we're running a public issue of Muthoot FinCorp. Apply now. Retail category. All we are trying to demonstrate to you that in the past, people said they did not have access, but access is very, very easy now. You say, okay, I want to invest 1 lakh rupees in this. You choose which one do you want. If your KYC or details are auto-populated, for under 5 lakhs, you can pay by UPI also. I will not again transact and make this payment. And basically, you can buy this bond. Bonds are issued in the primary market, means companies issued for the first time. 2 months ago, we had a large corporate Adani, which issued bonds and retail really liked that bond. We saw a lot of buying interest for that. important things that you can see is things here are bond directory. You can actually search for any bond here. You just start typing the name, let's say Tata, and you can search Tata Motors, Tata Capital Finance. This is a very important tool for fixed income investors. Earlier, people did not have this. All bonds you buy, you can actually go to and see a portfolio, in your portfolio, the entire bonds that you own. So for example, you can see this portfolio has 65 lakh bonds invested. Weighted average maturity 4 years, 9 months, 43 unique ISINs, and the system calculates your weighted average yield or your returns of the bond. It also gives you your entire cash flow till maturity. It gives you a risk weightage, which security, how much you have. Again, the bond industry is building a lot of advanced things like we have an equity market, investment by rating, etc. The system also sends you a reminder of your cash flows. For example, you can look at the cash flow that this much I've invested. This is my cash flow, and you can plan your cash flow for the entire of your portfolio. A lot of people say, why do we buy one bond? What if I don't know a specific bond? We have a product called Bond Case. Here, you can create your own portfolio only in 2 minutes. So let's say in this example, I want to create a portfolio for 5 lakhs. There are certain curated baskets for you, high yielding, monthly income, short-term bonds. So people sometimes say, okay, I want monthly income bonds. Here, if you look, this shows what is the amount to invest, average maturity of your portfolio. 5 bonds are auto-selected from the highest yield and your weighted average maturity. For example, you can say, okay, I don't like this name. This is just for example. Yeah. You can unselect a bond here and automatically calculates your portfolio that you have only one bond. You can add another bond here. So this allows you to create your own portfolio and make one single payment. Again, you just press invest now, and you can buy 5 bonds in one single payment. This journey, confirm and proceed, we've been there. I will not, I will let you explore the thing, but one very interesting factor that you can see here, and which I think Professor also likes and given us good feedback on, is the Bond University. We have created a completely interactive a repository of all blogs and videos. You can search for any term. It's an interactive model. Let's say you say option. It'll show you blogs. What is call and put option in bonds? Are bonds better option than fixed deposits? So the entire education material, unfortunately in this, in India, I think NISM making is a fantastic effort for teaching people on fixed income. This is built for self-education. As a university of bonds, there's not enough content, but we've built this for you. Again, that's all from a demo perspective. I've just shown you how simple it is to do KYC and investment bonds. Please go and try. This was not possible earlier and very easy now. I will pass back to you, Professor. We'll bring up that slide. Yeah.
Thank you, Vishalji. I think you cleared the doubts of most of the people that how to invest in the bond into 5 minutes. So,
sir, actually, it is 5 minutes. When we
yes.
talk to exchanges, people get surprised
Yes,
that
yes,
how
definitely.
easy it is
How easy it
to
is.
select, to navigate, to research. But again, the most amazing work NISM is doing. So I'll pass the mic back to you,
Yes,
and talk a little bit about the amazing SEBI initiative that.
yes.
you're
So
part of.
thank you.
Yes.
So on this part, again to create to create the awareness amongst the participants, because on the social media also, on personal calls also, on website also, we have seen the persons want to learn more about the fixed income securities, because at some point of time at the part of the webinar, it is difficult to join and something like that. So the NISM has taken an initiative with the FIMDA, and we are developing the short-term e-learning modules on the fixed income securities. Okay, so that we have started the 2 short-term fixed income securities modules. So number 1 is the overview of Indian debt market, association of the FIMDA and the NISM. So what is going to be learned? So you will learn about what are the money market, government debt market, corporate debt market is there. The duration of the entire module is the 3 years. That is a self-paced module is there. The e-learning videos LMS will be given to you. You can access this course for 30 years, and the course fee is 2,000 plus taxes. So if you successfully complete this course, you will receive a joint certificate from the NISM and the FIMDA. So that is the one course that we have there, and one more is there for the, can we go to the next slide, I think? Just previous, yes. So one more is the introduction to the fixed income securities. So again, the one more course that we have created the e-learning module, that what is the overview of the securities, fixed income security market, what are the various types and risk associated of the fixed income security. Again, that is the 2,000 plus taxes will be there, and same line of the previous course, it is a part. So these two e-learning modules that we recently launched with the FIMDA, and you can get access of this on the NISM website, and in the e-learning module part is there. And definitely we are coming with a more such type of module. So if you want to explore yourself in depth about this particular module, that will helpful to you. So that's a part of the current modules. We have the e-learning in the fixed income securities. So can we go on the, I think, question answers? Shall we take? Okay, so next.
Yeah, yes. So we are back to question answer. This is the most, sorry, before that, the next webinar, just to announce, we've been doing a series with NISM and everything, we're amazed and very happy with the turnout. Will be on 14th November, which will move on to the next topic on types of bonds. So slowly we dig into the entire fixed income segment. We hope to bring this series to you over the next few months. So this is just to mark your calendars. Emails and invites and social media will go up. We move on to Q&A, and a lot of very, very interesting questions have come around, and I think a lot of questions have been answered. But this question, I'll start with you, Professor. A lot of people ask, why should we invest in bond versus equity or mutual fund? What are the benefits? What are disadvantages? So I open that to you.
Yes, so thank you, Vishalji. So on this question, I simply say to you, first thing is that when it's about the mutual fund, so definitely the mutual fund is one of the segment. Even in the previous session also, we have covered the bond versus other asset classes was there. But when it's about the mutual fund, if you're investing to the debt mutual fund, you have to pay the fee, that is expense ratio, to the mutual fund company. Over here, you not have to pay the expense ratio. That is one of the parties there. Number two, when we compare to the equity is having a challenge of, most important challenges of the principal amount is one of the important challenge. The risk is there. Majorly, if you can see the Indian market or the global market, due to the global crisis or geopolitical risk, you can see the daily market is going down and some parts are there. Definitely, the equity will give over the period of time longer, higher return to you, but it is not as stable. So for getting the stable income, regular income, and the principal amount safety, bond is one of the good option as compared to the direct equity. And definitely the mutual fund schemes are there, so which have the expense ratio incurred over there. Anything you want to add on this, Vishalji?
Absolutely. I think bonds should be looked as a portfolio diversification tool. I'll maybe address some of the other questions. How much bonds should you have in a portfolio? People have asked. So typically, globally, people do a 60-40 allocation, equity to bond. In India, we at least advise 20% should be part of your portfolio, maybe 60 to 70% in equity, and rest in gold, real estate, etc. That you want. There are a list of questions which I'll quickly answer this time. Taxation is a question which has come repeatedly. There's a 10% TDS on all coupon payments on listed bonds. There is 12.5% long-term capital gains if you sell a bond at a profit. For example, we anticipate interest rates to come down in India, and if you were to make capital gains, then that's 12.5. Rest of the coupon is at your slab rate.
Yep.
There's a question, can retail participate in primary market? Yes, retail can participate in primary and secondary market all along. This question, Professor, to you, RBI has indicated possible cut of rates. Is this a good time to enter the bond market? And should one go for long-term duration or short-term bonds?
Again, when RBI will definitely, when the cut rates will be there, so it will affect the price of a bond. So when the price of a bond, it will be the capital gain on the bond. Because the yield will go down, the price of the bond will go up. So if you are investing for the medium to short term to medium term market, and suddenly the RBI will cut a rate, the price of the bond will be there, and there is an opportunity of the capital gain for you. So a part of the principal amount, you will get some additional amount at the time of maturity for you. For a longer duration bond, again, when we covered the risk part, at that particular part also we discussed, if the higher the maturity, higher the risk will be there into the bond. So liquidity risk can be there. There can be certain more economical things will be there. So if you're investing into the bond to the shorter to medium term or medium to upper or the lower, what we can say long-term bonds will be there. So that will be good for the investment options for you.
So maybe I add here, typically one should invest in higher return bonds for the short term, because the companies who offer you higher returns, you don't want to invest. And we have seen a lot of people investing in long-term government bonds. So, you do a barbell strategy where you earn your yield in the short end with high yield and risk-free in the long run. There are very topical questions on credit ratings. I hope we have answered that question. There are questions what to do when there are news which, like the recent NBFC. We don't want to comment on that. All we'll say that IndiaBonds did organize a webinar with Navi FinServ management yesterday. So, we are pretty proactive in putting you in touch with companies. Again, there is no guarantee or assurance, but we always do that kind of client servicing. Sir, what is people asking from investor protection? What can they look forward to for investor protection? And how can they go and complain if there's something goes wrong with a bond?
Yes. So again, the best part is that since if the listed bond is there, so regulatory is SEBI, so you can file a complaint if any wrong practices has been done. So Score is one of the complaint platform for the SEBI. And when you buy a bond, so there is a debenture trustee is there. So he take care, or that particular institution will take care for the entire compliance part of the bond which is issued by the company. So that is the trust is there, debenture trustee is there. You can file a complaint to debenture trustee. And again, if no resolution is there, SEBI is the final authority. You can put your complaint on the SEBI platform also.
Okay. One question is, to repeat a slide, let me tell our viewers that after a few days, we will put it on Bond University on IndiaBonds, where the recording of the video will be available, and you can, and on YouTube, and you can go and see that. A person asking, sir, can my equity portfolio be used as margin for buying bonds? I think you should do the other way around. Use government bonds as margin for equity, than buying bonds, because just the nature of return of equity is there. One question, I'll probably go for it. 0% coupon bonds, tax treatment, is it capital gains or interest? Very interesting question. There's a public sector tax notice bond came, 0%, 10-year. In that, the entire interest or principal, I think it's around 50s, will be treated as long-term capital gains. And that's why it came at 6.15. People have asked on taxation. There are also tax-free bonds issued by public sector. They yield around 5.3%. So post-tax, you get in 8.5%. Again, we are not tax experts, so we cannot advise you on tax. Please ask your tax advisors, but this is from common knowledge. Someone has said, sir, my friend will never return my money back if I give it to him. So give me a realistic example. I think, Professor, you want to take that? Use a company PSU? Yes.
So again, always look for a friend who will give you money back.
His credit risk is not good.
Credit risk is not there. Yes.
No, but jokes aside, there are public sector issuers which are owned by government, and the government bonds themselves. So in this example, we just use friendlily. But yeah, corporations are bound by contracts and governance and SEBI to look after. As Professor said, there are trustees who take care of your interest to make sure the money is paid, and they'll notify you actually if they are not.
And best part, if you don't want to take a liquidity risk, the GSEC is one of the best examples, especially in India. So there is zero risk bonds are there. So your principal will be back to you.
Yes. How is investment bonds helpful in emergency situation? Would you want to?
Yeah, in emergency situation, again, I'm just giving some best example to you as a part of the financial planning prospect, we can say. If you're working and there is a saying that at least 6 months of the salary should be kept as the contingency to you, and it should be liquid also. That there is a two part, contingency as well as a liquid. Okay. So when it's about the contingency is a liquid, every year, every week, T-bills come with an option. So you can create a portfolio or you can create a fund with the help of T-bills where the liquidity is there. So that is one part, emergency as a part you can say. And the T-bills having maturity of 91 days or 182 days or 364 days is one of the part. That is one part. And again, if you want to sell that particular bond into the secondary market, yes, the platforms are available. You can sell that particular bond on the secondary market and the liquidity will be generated. So these are the two parts. Vishalji, if you want to add on this part, so.
Yeah, so liquidity in the secondary market depends on the rating. So
Right.
government security AAA, AA plus has very, very, very high liquidity. There are tens of billions of dollars of government bonds that trade every day in the Indian market. So, again, the liquidity strategy around the portfolio should be that 20% of your bond investment you keep in very liquid if you need it. Hopefully, you have other avenues for liquidity. Bonds are usually a hold to maturity instrument in some cases for capital preservation, but in this interest rate cycle, could be a good place to earn much higher returns. A question, what is ratings under watch? Uh, when a credit rating agency, an event happens, is not sure as to what their next move will be, or there's a negative news, they put it in ratings under watch, which means they will review the company and take some action, take some action soon. A very good question. What is some of the indication that credit rating is going to go bad of a company? Very good question. So usually there's a lot of company negative news starts coming, equity share price starts going down. Ratings nowadays do not move very rapidly. So maybe people talk about people's memories are small. So people in bond market, due to lack of awareness, talks about divan housing and things like that, bad credit incidents that happened in the country in 18 to 19, where from AAA it went to default. But nowadays it doesn't happen. The trustees and the rating agencies are much, much more vigilant. It is like saying Nifty was 5,000. Why is it 25,000 now? So India has grown $3.5 trillion since then in the last 6 years. So right now we have very, very good regulatory framework. One question is on NRIs. Does IndiaBonds cater to NRIs? There is not enough clearance in the process right now. So at the moment, we are not catering to NRIs, but we are working with SEBI to make it much easier for NRIs, right? Please clear the concept of coupon and yield to maturity. Professor, to you.
Yes, so as a simple example is to you, the coupon is at the time of issuance. The company will say the first slide, if I'll come to you, so 10% on the face value. So coupon will be frequently received by you. Now, what the assumption for the yield to maturity is that if you reinvest that coupon at the same rate, what will be the total return? That is a rate of return you're going to receive. So 10, for example, you purchase a bond at 1 lakh rupees, you are receiving 10,000 rupees coupon every year for 10 years. You're reinvesting that 10,000 rupees again every year at the same market rate. Then the maturity return, at the maturity, you are going to receive 1 lakh rupees back. So total return, that is a compounding return will be there. That is a yield to maturity will be there. So yield to maturity can be more than the coupon, can be equal to the coupon, can be less than the coupon. If the yield to maturity is higher than the coupon, in that case, you will see that bond is traded at discount into the market. It means the current market price of a bond is less than the face value. If the yield to maturity is lower than the coupon, in that case, the bond will trade at the premium. So current market price will be higher. And if the both are same, the bond will trade at par. So yield to maturity is the rate of return on that particular bond with having an assumption that whatever coupon you're receiving, that coupon you're reinvesting into the market at same rate.
Yeah, just to add, the coupon is fixed at the time of issuance, right? So company says today I will issue a 5-year bond and give you 9%. But market factors can make interest rates go up and down, credit quality change. So yield to maturity captures that.
Yes.
Sorry, there are a couple of questions pertaining to our platform. No, we do not have any transaction charges. People who use you want an Excel download sheet from the portfolio. Yes, we are working on that. In 2 to 3 weeks time, you will have that available to you. Again, a lot of questions on charges on our platform, at least we don't. So there are a lot of questions on duration, modified, and Macaulay. I know it's an advanced topic, but is there a brief way for you to explain?
Yes, so definitely.
8 questions on that.
Yeah. So we are going to do the upcoming webinars also on the duration. Basically, as a part of the risk, liquidity risk is one of the parts. So when we expand the liquidity risk, the duration will be there. So duration is in the simple terminology, if I'll say to you, if I'm investing 1,000 rupees in a bond, I'm getting a coupon. So my investment is 1,000 rupees. My investment is 1,000 rupees, and I'm getting a coupon on that particular bond, and some maturity value will be there. Okay, or the redemption value will be there. So whatever amount I'm investing, how much time it will take to give me back by discounting with certain rate. by discounting with certain rate. So simple example, if the duration of a bond, the macular duration or the duration of a bond is less than the maturity, in that case, yes, to investment in that bond is a good option. But it is higher than the maturity, then again, the investment in that particular bond is not a good option. So duration of a bond is nothing, but the time or the total period that your investment amount is coming back to you by discounting with yield, by discounting with the yield. That is a simple concept.
May I just add for bond investors, this is more professional, but modified duration also defines the riskiness of the bond, right? So higher the duration, for every interest, 1 basis point, 1% interest move, your price will move much more. Again, some questions. I'm an FD, MFD. How can I? Any questions relating to India bonds, please write to us contact us at India Bonds and we'll respond to you. Very good question. What is secured bonds? Maybe I'll take this question.
Yes,
so
yes,
when
please.
company issues, a bond, it can tell you that, this bond is secured, which means either they pledge in the olden days, if it's a manufacturing company, a plant or a machinery, saying, I'm raising money against this building. NBFCs pledge loan receivables that I'm due to receive this money and I've secured these receivables against the loan or the bond that I'm taking. Secured bonds are better than unsecured bonds in structure because they are against an asset class. In case of default, there is some recovery value. In this case, maybe a second question was difference between equity, preference share, secured and unsecured bonds. In case a company goes default, secured comes first, then unsecured, then preference shares. And if there's any money left, you get equity. Equity guys get paid.
Only the face value of equity, and that is the most important part.
Yes. No, absolutely. I am processing through the questions. Whether bonds have defaulted, as we said, bonds have defaulted in the past in India. Not only in India, globally bonds default. It's an asset and a security where there is a default. As a platform, we haven't offered anything which has defaulted. We do a little bit of a pre-selection, but we do not have advisory. We advise you to see on your own. Sorry, sir, I'm just going through all the questions.
Please.
Thankfully, we still have, again, duration. Can bond make wealth? What do you think? Professor, back to you. And the purpose of bond investment. Yes.
Yes, definitely. Bond can create a wealth. So that wealth is the what I can say. That wealth is the slow and steady. That is a example. So something is slow, steady wealth will be there. Again, when it's about the Indian market, especially the upbringing has been done in our generations, or upbringing has been done by our parents. We'll say about the fixed income as a fixed deposit. That is a perception. So yes, if the fixed deposit can create a wealth, the bond will create a much more wealth than the fixed deposit. That is a part. Yes, it will create a wealth and regular income also to you.
Yeah. A lot of people are saying corporate bonds are better or government bonds. Let us explain again. Government bonds are considered risk-free, will give you a lower return. Please look at credit rating. Please study the information memorandum. The lower the rating, higher the return, but higher the risk. There are a lot of questions on webinar participation certificate. Yes, in the next few working days, NISM ensures that the certificate is issued to you if you have attended the webinar for a certain duration of time. So absolutely, certificate will be given to you. Next question. There's a lot of duration questions. Again, we have written on this topic. You can read that. It's a bit more technical, so we will not cover it.
But upcoming we'll do some seminar, webinars on this durations and that part. That will definitely.
Yeah. There's a question. What will happen if India bond, will India bond guarantee default? There is no guarantee by India bonds. There's no guarantee by anybody for a bond to default. Every investment comes with risk. Please understand the risk. It is your money. Please study and please get to know a little more. One question is, why not go for liquid funds and debt funds which have no exit load? Very good question. Do you want to take it, Professor?
Please, Vishal. Yes. I think that one part of that mutual fund I covered. So if you can throw more light on this part, so that will.
Liquid funds is if you really need short money, like 1 week, 2 weeks, The return is much, much lower in liquid funds. You get instant liquidity, and that's why it's called liquid funds. In fact, in the debt mutual fund industry, there are 14 lakh thousand crores, out of which 60% lie in liquid funds. Debt mutual funds tend to give lower liquidity, higher liquidity, but lower return. When you do direct bond investments, you can structure your own portfolio and, by bond case and things, and try to earn a higher return. A question is, treasury bond is what? Treasury bond is a term from US, America, which is a government bond. So हमारे यहाँ उसको हम GSEX या GSEX we call it, or gilt. Is that what we call, right? I think, one second, I think we try to cover at least 50 to 75 questions. If I've left anything, 1 second, let me just view.
I can see one question was there on the FD part. So bank is having, if
Yes.
you do the FD.
DIGC, yes, insurance.
DIGC,
Please,
yes.
please, yes.
So on that part, yes. So if you on the counterpart of this, you will do the 50 lakh rupees FD with the bank, and if the bank default become, suddenly it will not happen, but if become defaulter, so maximum insured amount is 5 lakh rupees only. But if the company become default at the time of liquidity, you will get your 50 lakh rupees principal back. So that is the part in the bond. So there is no insurance, but yes, liquidity as a part of the liquidity, some part, the face value will be given back to you if the secured bond is there. So security will be covered, but there is no insurance in this part.
Yes. Also, one question I saw is, how do I sell the bond? Again, on our platform, you can request for quote on a best effort basis. We try to find you a buyer. We're not allowed to show like an equity buy and sell prices on a platform under regulation. Otherwise, we are a deemed exchange. But usually, we do not guarantee buyback, but we make our best effort to help you find a buyer. Sir, if a credit rating of bond is affected, affects the bonds of the company, yes. If a credit rating were to be downgraded, or from, let's say, AA it goes to single A, then the price of the bond typically will go down because it has become more risky. So people will want a higher return to invest in this bond. Anonymous attendee, a word on India bonds would be appreciated. We are a SEBI registered regulated entity. We are co-founded by myself and my co-founder, who also owns a company called AK Capital, which is a bond house. We are an independent standalone company owned by both of us and regulated by SEBI. We are members of NSE and BSE both. We are a 100-member plus team. Our effort, like NISM effort, is to educate our country with more bonds, knowledge about fixed income, and give people easy access and use technology to give them easy access. I think that brings us to the closure. Very happy to see that even more than 600 participants are still on our webinar. I hope you've gained from today. Before passing on to Amir for closing comments, a sincere thank you and appreciation to NISM, to Professor Shrimal, to Shri Bansal, who's also on the call, for participating with us and being in this journey for education for fixed income. And thanks to all our participants. Amir, over to you.
Thank you so much, sir. And now we are on the officially closing of that webinar. So I'll just take few minutes to thank each one of you. So thank you all the participants for joining today's webinar, which was on factors to consider before investing in bonds. Special thanks to both the speaker, Vishal sir, Kapil sir, and the very much explanation of the platform given by the IndiaBonds, as well as the patiently answer all the questions by Kapil sir as well, along with Vishal sir. So on behalf of NISM and IndiaBonds, I would like to thanks each and every participants who have joined the webinar. Because of their interactive questionnaires and the engagement activity, the webinar has been very much valuable to us also. So we hope now we will be more confident enough to include the bonds in a portfolio. So, and last but not the least, thank you all the NISM team and IndiaBonds team for conducting this webinar. So thank you and happy investing.
So thank you, Vishal ji, on behalf of NISM. It's a very pleasure to have conduct a webinar with you, and definitely we'll do some more webinars on the same part.
Sir, the pleasure is ours. Thank you so much for being part. Thank you to our attendees. Happy investing.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.